In a world of endless growth, governments borrow trillions to fuel dreams. Yet this invisible force erodes foundations silently. $338 trillion in global debt towers over economies, promising progress but hiding a burst that could shatter lives. What if the next crisis is not just numbers, it is your future? Today, we delve into the hidden truth of mounting sovereign debts worldwide, illustrating economic patterns of boom and bust cycles that equip you with insights to anticipate personal financial impacts. This is not just history, it is a repeating rhythm that demands we rethink our economic reality. The global debt bubble traces back to the 1940s to 1970s, the post-Russell's boom under the Bretton Woods era, where governments accumulated debt for reconstruction, but fixed exchange rates and gold standards curbed excesses. The turning point came in 1971 with the Nixon shock, ending the gold standard and unleashing fiat currencies for easier borrowing. Oil shocks in the 1970s fueled motivations for more debt, as entities like the US Federal Reserve under Paul Volcker hiked interest rates sharply. This set the stage for broader historical context. A supercycle of debt since the 1980s, financial deregulation, amplified by globalization and aging populations in advanced economies, governments as primary borrowers, like the US with its current $35 trillion debt at 102.69% of GDP, mirrored early patterns. Motivations included funding wars, welfare and infrastructure, but conflicts arose from fiscal imbalances, such as partisan US debt ceiling debates in 2023. The 1990s Asian financial crisis from 1997 to 1998 exposed risks, with Thailand's Beit collapse in July 1997 as a pivotal event due to rapid capital inflows reversing central banks like the Bank of Japan, with its 200.93% debt-to-GDP ratio today, began enabling through low rates. Entering the 2000s, the dot-com bubble and low rates post-2001 recession fueled US housing leverage. Private investors, holding bonds like Japan's $1.1 trillion in US debt, sought safe yields, but motivations clashed with risk aversion. Organizations like the EMF, led by Kristalina Georgieva, and the World Bank shaped the story through bailouts, motivated by stability but conflicting with borrower sovereignty, as seen in the 1980s, Latin America austerity critiques. Individuals like Ray Dalio of Bridgewater Associates warned of debt cycles, while Nouriel Roubini predicted crises, their roles highlighting motivations and conflicts in investment strategies amid uncertainty. The 1980s Latin American debt crisis, triggered by oil shocks and Volcker's high rates, led to Mexico's 1982 default, a major turning point. Immediate effects: market volatility and recessions with banks strained. Fast forward to the 2007 subprime mortgage escalation, culminating in Lehman Brothers bankruptcy on September 15, 2008, ballooning global public debt from $33 trillion in 2007 to $66 trillion by 2010 via bailouts. Governments, like the US, faced high-stakes decisions clashing with political pressures. The 2010 to 2012 European sovereign debt crisis began with Greece's 2009 debt revelation, leading to ECB's 2012 Whatever It Takes pledge by Mario Draghi, a stabilizing but debt-increasing move. Causes: structural aging populations and deregulation enabling leverage. Long-term consequences included slower growth, with debt-to-GDP ratios projected to 123% in advanced economies. By 2030, unexpected second-order results: inflation eroding savings and increased inequality as austerity hit the poor hardest. In the 1997 Asian crisis, short-term foreign debt vulnerabilities caused currency devaluations and defaults. Entities like China's PBOC, holding 51.8% of global government debt with the US, navigated motivations for stability amid geopolitical tensions like 2018 US-China trade wars. Controversies arose from IMF austerity versus social spending, with high-stakes decisions like 2023 Zambia restructuring. Private banks like JP Morgan, as bond buyers, faced conflicts and sell-offs during crises. Debt cycles are predictable: boom from low rates, bust from hikes. Core concept: sovereign debt as government liabilities via bonds, with a debt bubble as unsustainable accumulation risking defaults or inflation. Debt-to-GDP ratio measures sustainability. Over 100% signals risk, like Italy's 132.5%. Quantitative easing by central banks like the Fed under Jerome Powell since 2018 lowers rates, but interconnects public and private debt in crises. Common misconceptions. Debt is always bad, yet some fuels growth. Or governments can print it away without inflation, ignoring money velocity. Patterns repeat due to low post-2008 rates, and COVID stimulus adding $21 trillion in 2020 to 2021. Emerging markets face high borrowing costs and commodity shocks, with 54 countries in crisis affecting 3 billion people. Net debt outflows doubled in developing nations over a decade. Geopolitical instability from debt traps in Africa via Chinese loans creates migrations and innovation stifling as resources divert to service. OECD sovereign issuance hit $17 trillion in 2025, up from $14 trillion in 2023. Central conflicts, creditor versus debtor nations like China lending to Africa, domestic like US ceiling crises risking default, tensions, rising rates versus growth. As Fed's March 2022 hikes combated 9.1% inflation peak in June 2022. The 2020 to 2022 COVID response via US CARES Act in March 2020 added 25% to pre-pandemic levels, pushing global debt to $338 trillion by H1 2025, public at $102 trillion in 2024. Christine Lagarde's ECB since 2019 continues QE amid conflicts. William White, former BIS economist, predicts triggers. Global debt bubble about to trigger financial crisis. Arthur Laffer echoes, debt globally is coming to a head, it will not end well. Modern parallels, China's $14 trillion debt, holding vast US bonds amid de-dollarization by BRICS, high-profile defaults tied to fraud, and climate debt links where events worsen fiscal positions. Immediate effects today. Higher interest payments crowding investments, with post-COVID debt 25% higher than 2019. Long-term, existential threats tying into personal economic futures like unpriced carbon burdens, controversies, 2025 to 2029 potential restructurings as high stakes. Joseph Stiglitz notes, there is growing consensus among experts that the current debt system serves neither creditors nor debtors well. When it bursts, defaults trigger volatility, recessions, bank strains. Consequences, slower growth, inequality, with AI tech potentially offsetting but climate events amplifying. Debates rage. Modern monetary theory advocates like Stephanie Kelton argue sovereigns can deficit spend focusing on inflation limits, contradicted by critics citing hyperinflation risks like Zimbabwe. Optimists see low rates sustaining. Pessimists rate crisis risk at 3 out of 10, Ben Bernanke reflected. The lesson of history is that you do not get a sustained economic recovery as long as the financial system is in crisis. Real people faced migrations and eroded savings lessons. Monitor yield curves for bursts. Build 3 to 6 months emergency funds. Insights. High debt amplifies inequality. Invest in skills for shifts. Ray Dalio warns, you create a cycle virtually any time you borrow money. Buying something you can't afford means spending more than you make. Practical principles. Hold inflation-hedged assets like gold. Advocate fiscal responsibility to avoid tax hikes. In this world of borrowed prosperity, the global debt bubble is not inevitable doom. It is a call to understand patterns and act. Echoing our thesis, these boom and bust cycles equip us to anticipate impacts, shifting perspectives toward resilient futures. Contemplate. Your choices today shape tomorrow's economy.